So apologies to Bradley. I put Nick on here and I forgot about him as well. This is all done in a bit of a rush. But there we go. But good morning anyway, both of you.
Morning. Good morning.
As per usual, can you sort of tell us a bit about the fund and the state of the market, please? And then we'll do some questions.
Most certainly. Thanks, James. And delighted to be stepping in. Thank you, everybody, for joining. And because we actually think the company's in a really interesting place. So Bradley and I, we look after this company together. We've got slides that talk to the strategy where we see us as being differentiated against the peers, particularly given a recent pivot, if you like, to our strategy to incorporate a more thematic focus on, broadly speaking, how sustainability characteristics as part of our asset management strategies will allow us to enhance shareholder returns further. But what we thought we'd do, and it will be a tag team, but what we thought we'd do first of all is just set the context. Because we think for lots of different reasons the UK market is looking more interesting, frankly, than it has done over many years. And the key reason here is the chart on the left-hand side. So this is data for average UK real estate value. So this isn't data for our company, and I'll come back to that later. But what you can see is the dotted line there, which shows the movement in capital values from June 2022, which is the most recent cycle peak, and how, for different reasons, obviously interest rates were beginning to rise ahead of the mini budget, but obviously with the mini budget, we saw an acceleration in the increase in gilt yields. And obviously, as a real estate asset comprises both bond-like characteristics and equity characteristics, and I'll come back to both those a little bit later, the rise in interest rates obviously resulted in real estate yields rising, which resulted in that very sharp correction. And the dotted line there you can see is showing that average values in UK commercial real estate are down about 25%. From June 22. Now, what's also interesting is if you look at how the other sectors fared. So, for example, the dark blue line there, industrial. The industrial sector fell about 27%, which might be slightly counterintuitive because actually we think it's probably the best sector going forward. But of course, the reason for that is because the industrial sector was producing lots of rental growth. As a result, investors were prepared to accept low initial yields. And so when we saw the rapid expansion in gilt yields and interest rates more generally, then the industrial sector, being a more low yielding sector, was more adversely impacted. Final point on the left, you can see the office sector there. Whilst the industrial sector has bottomed out, we are still seeing nervousness amongst investors within the office sector, values continuing to decline. But actually going forward, taking a sort of a medium-term view, we actually think that sector, not least because of the headlines that we've all been reading this week about return to work, it is going to represent an interesting opportunity. Now, I guess just also to look at that relationship between yields from real estate and gilt yields in a bit more detail. So over the long run, the average spread between the 10-year gilt yield, the risk-free rate, if you like, and average property rental yields, which we call the initial yield, the green line there, is anywhere between 100 and 200 basis points, 1 to 2%. And you can see that relationship represented by those grey bars. That's showing you the spread between the two. Now, you can see in the run-up to the correction, particularly 17, 18, 19, very significant spread. Of course, that was more to do with quantitative easing, gilt yields being pushed down rather than being real estate specific factors. And you can then see, obviously, with the sharp movements in yields at the end of 2022, the spread narrowed significantly. But what's interesting now is with gilt yields at around, just under 4 today, and average real estate yields, depending upon the index, of between 5 and 5.5, we are moving, we believe, from a yield perspective towards the market representing fair value. And actually, if you look at most forecasts for interest rates, and obviously there's a lot of noise out there around inflation, and I think our view is that inflation will remain probably above target, taking a medium-term view, not least not least for reasons such as decarbonising the economy, which is obviously a theme we're talking to here. There is an expectation that 10-year rate might trend down towards sort of the mid threes, perhaps even lower, which would mean that we're absolutely back in line with those long run averages. So just moving to the next slide, which I think is also really different insofar as that sort of history doesn't repeat, but it echoes. And what's different compared with previous downturns? So, for example, to set that recent decline in context, average real estate values between 2007 and 2009, so during the GFC period, went down about 44%. So if we end this cycle with values falling between 25 and 30, you can see it's a very significant correction. But what's really interesting, in contrast to those previous downturns, is rents, at least in nominal terms, are still going up. And that's what we're illustrating here. So you can see there that the dot-com boom following the 89 crash, you've got 2007, obviously the GFC, and we're showing you what rents are doing from if you like, the peak of those different cycles as we went into that downturn. And you can see in average terms there, compared with where we were in June 22, average rents, that's the red line, you can see they're up about 5%. And actually, if you look at the rental growth over the last 12 months, all sectors produced positive rental growth. You've got all property at about 4% over 12 months, the retail sector slightly positive, offices interestingly over 2% growth, but with industrial leading the way at almost 8%. And that's what you can see on the right-hand side. In contrast with the period after the GFC, clearly we've got much more structural support to the sector, the tailwinds coming from a shift online, obviously nearshoring, physical retailers restructuring their supply chains and so on. So actually, from a rental growth perspective, which is obviously what delivers the equity component of that real estate total return, much more positive. And a last point on this slide, despite all the headlines we've been reading in relation to weaker growth, because of that recovery, because we don't have an oversupply issue in the real estate market in the same way that we did in previous downturns, actually the last 12 months is the fourth best year for rental growth over the last 20 years. So really contrasting that yield movement with leading to the downturn versus obviously the fundamentals in the market, supply, demand, and that growth coming through. So moving to the next slide, just setting context. The other trend we're seeing is we're beginning to see mispricing emerging, which we believe should play to our skills in terms of active management using the specialist expertise that we have across our real estate team. What the chart on the left-hand side is showing is a relationship between prime office yields, and prime means very best in class, long lease, good tenants, versus secondary office yields, which are represented by the blue bar there, which is where you may have a shorter lease, where you've got the opportunity to add value through refurbishments, etc. But of course, because people have been so negative about the office sector, and we think actually, probably incorrectly, some investors conflating what's happening with the US office market, which is in a much more difficult state because of much more supply side risk, a slower return to work, particularly on the coastal cities. We're seeing this huge spread between prime office yields and secondary office yields, and that's what's represented by the shaded area. And that average spread there at the moment to about almost 400 basis points, 4%, versus a long run of less than half that. So if you then overlay the supply side point I mentioned on the right hand side, where we're showing net office additions, and again, it's really interesting. If you look at the last 4 years, there's been a 5% reduction in total office space, and that's because offices, particularly in cities like Bristol, where you've got student demand, offices are being converted into other uses. But at the same time, that lack of development finance in the office market mean that not enough new space is being built, and that's what you can see there in the forecasts. Relatively low levels across all those key big six regional office markets, and actually, broadly speaking, the same point applies in London. So I mention this, not because we're about to go and significantly increase our office weighting. If anything, as I'll show you in a moment, we're 50% weighted to industrials at the moment, and that's likely to tick up with activity. But I mention it because actually, when you get behind the headlines, actually, even the office sector, where there has been caution amongst investors, we think actually going forward potentially creates some really interesting opportunities, particularly when you've got the specialist expertise that we have, the operational excellence, the ability to invest, particularly in delivering sustainability improvements, which, if you look at the big regional cities in London, for the very best buildings, rents have never been as high. So moving forward, just to give you, if you like, a snapshot of the company. So what does it say on the tin? Well, you can see there, we have evolved our strategy. So we were finding an increasing part of what we're doing in terms of active management across our portfolio is being driven by delivering sustainability improvements, and the real estate industry is in the crosshairs clearly of regulators, of governments, because as a sector we contribute about 40% to global carbon emissions, and at the same time companies, larger corporates in particular, 70 or 80% of the FTSE 100 have made their own net zero commitments. So we're finding increasingly that occupiers are requiring us to deliver space that delivers those sustainability improvements, but also the improved amenities, particularly for the office sector, as companies are looking to attract people back to work rather than tell them to come back to work. So we've evolved our strategy, and we got shareholder approval to incorporate KPIs that specifically relate to delivering sustainability improvements, which I'll come on to in a moment. But fundamentally, we have a good quality portfolio. As I say, we're differentiated, we're diversified both by geography and by sector, but with a real focus on those higher growth parts of the UK. So, for example, as I said, 50% of our portfolio, you can see in the pie chart there, is weighted towards multi-let industrial estates, which we think will deliver more growth than the big box, because the big box sector has got a bit more of a supply side risk. Our office weighting is 25%. 10% of that office weighting is in fact offices that are used as universities, because what we're trying to do is acquire assets in locations that attract that mix of uses, particularly in knowledge-based economies where you get that. Our retail exposure is very much focused towards convenience, and I'll give you an example of that in a moment. And so you can see there, our approach overall is leading to good performance relative, but actually from an absolute perspective as well going forward, we think the sector does offer really interesting value. So moving to the next slide. So the next slide just gives you a bit more of a snapshot of our portfolio. And you can see from left to right, what's really good actually, if you don't know us so well, is you can sort of get under the bonnet quite quickly. These 6 assets represent about 50% of our portfolio value. So you can get a really good idea about the quality of the portfolio. From the left, these are our 2 largest assets. A very good multi-let industrial estate in Milton Keynes. One of the largest contiguous industrial ownerships on the outskirts of Leeds. Both of those assets generate very attractive yields. We've got yields of north of 6% as we crystallise reversion, so where the rents are where the market rents are higher than the rents that we're currently receiving. But they're also very granular in terms of income. A large part of the reason for us having over 300 tenants is because we bought these very large multi-let estates where you've got really granular occupier base, no dependency on any particular segment of the economy, just nice granular, lots of different businesses. Now, the office sector, as I say, actually, almost half of our office weighting is actually where we have buildings used as office, as universities rather. So you can see here our 4th largest asset, but our biggest office asset is an asset in Bloomsbury. So we've been investors across our strategies where we've been looking to take advantage of new infrastructure, and obviously Bloomsbury is benefiting partly obviously from Crossrail. Or Elizabeth Line, as it's now called, all the works up Tottenham Court Road, but also the connectivity with UCL and obviously, the sort of a knowledge-based quarter, medical quarter up at Euston, but also then going across to the tech cluster at King's Cross. So we've got a really interesting building here, low rent, but where we think we can add significant value long term. Manchester's clearly a city that has benefited from infrastructure investment, the tram, notably, but also clearly things like the BBC moving up to Salford, and so we have a big lump of property here right in the middle of Manchester city centre. Again, high yield, mix of uses, office, but also a hotel, and also, as it happens, a university. So, really interesting office portfolio that we can actively manage. On the retail side, again, we are seeing a recovery in retail. We are seeing more investor appetite. Clearly, it's been a sector in the doldrums, almost 10 years now, being on the other side of the coin to the tailwind supporting the industrial logistics sector. But our retail assets are really focused on convenience, not fashion, but for example, retail parks like the one I'm showing you here, where we had a home base, but we took them out and we relet that to both Lidl and Home Bargains, great value retailers who drive footfall. And then another example, Headingley Central in Leeds, so this is just north of Leeds city centre, catchment dominant parade of retail, anchored by Sainsbury's, but also where we had an empty office, which we've converted into a Premier Inn. So all the parents, when they're visiting their kids at Leeds University, will stay in the Premier Inn rather than student digs, and Premier Inn give us a long lease with inflation-linked reviews. So that's just a sort of a quick snapshot, if you like, of the portfolio. Now, moving on, I guess for those, again, that don't know us, I'd say these really are the 5 key reasons why we think you should be you should be considering us against peers. So I guess the first point to note is we do have a good quality, diversified portfolio, but importantly, with a high income yield. We've always tended to have a higher income return than our peers. That's generally because we've been buying, sort of not quite the worst house on the best street, but we've been buying higher assets where we can drive revenue growth through asset management. What that higher yield allows us to do is to pay a very attractive dividend. So on today's share price, the dividend yield reflects a yield of about 7.6%. And importantly, on the most recent financial reporting we did to the interim end September, that was more than covered by earnings. Balance sheet, we have genuinely a really attractive debt structure. So we have 75% of our debt is fully locked in for 12 years at 2.5%. That's fixed for that period of time, and Brad will give you a bit more colour right in a moment. And partly, obviously, reflecting in the dividend yield, our NAV, or rather the share price, reflects a 27% discount, give or take, to the NAV. So, we've obviously had that correction in capital values, but investors buying today are also benefiting from that discount. And the final point to note, and again, we are really trying hard to differentiate our strategy against some of our peers. We are really clear that we have a disciplined approach on improving our portfolio sustainability credentials. We're agreeing key performance indicators with the board that are connected with the launch of a new strategy, which will allow us to, we believe, manufacture that green premium that Bradley will talk to in a moment, and obviously over time enhance returns from our shareholders. So moving to the next slide, final one from me before handing over to Bradley. This is just a bit more colour on what we have done in relation to this strategic change. Again, really important to say, this is about driving higher and more sustainable long-term returns, because we believe by having a more clear approach to how we're managing sustainability risk, and as I say, we're having clear KPIs that we agree with our board, it will allow us to drive higher returns for shareholders. And the cornerstone of this is a proprietary scorecard we use for each individual asset, which will allow us to track progress. And as I say, really clearly, this is about enhancing long-term returns, but it's also about, one of the reasons we're very happy stepping in today is getting that message out there, driving demand for the shares, and actually possibly also capturing new sorts of shareholders where, for example, wealth managers have particular allocations for strategies that have a genuine sustainability dimension to them. So with that, I'll pass over to Bradley.
Thanks, Nick, and thanks very much, James, for having us on the show. So on this slide, Nick's emphasised very well that this strategy is about enhancing total returns for our shareholders. And what we'd like to do here is set out how we intend to do that. And what the strategy recognises is that new laws and regulations being implemented by government and other authorities to combat climate change are changing the behaviour of investors in real estate and the occupiers of real estate. This in turn is impacting the valuation of real estate. And what we're seeing is that for buildings that demonstrate some or all of the characteristics shown in blue along the top of this slide, well, they're able to command a higher rent and a higher value versus buildings of a similar age and in a similar location that don't demonstrate these characteristics. So why would an occupier be willing to pay higher rent for an asset that demonstrates some or all of these characteristics? Well, businesses, they want to attract and retain their staff, and they want them to come into the office. They want to reduce their utility bills, and they've also got their own carbon targets to achieve. And then from an investor perspective, why would they be willing to pay a higher price for buildings that demonstrate some or all of these characteristics? Well, they let more quickly at higher rents, they have less vacancy, they require less capital expenditure in the long term, and they're less likely to become obsolete as more stringent environmental regulation is introduced in the future. So the opportunity for us is to identify these mispriced assets, and Nick's outlined how there may be some opportunities in the office market, for example, implement CapEx programs to introduce these characteristics into the building, push on the rents, push on the valuation as a result, and then sell the asset and then recycle the proceeds and start again. Now, in terms of the quantum of this green premium, well, what we see is in London offices, there's around a 20% valuation premium. And that's really well documented, and there's lots of empirical evidence. In the regions, so looking at regional offices, we've undertaken our own research in collaboration with the PMA, and we've found there to be around an 8% valuation premium or green premium for regional offices. And our view is that will trend up over time, heading towards that London premium. And then looking at multi-let industrial estates, it's very difficult to get the empirical data here because of the nature of the assets, but we estimate there to be a 5 to 10% green premium, and actually we think it might be higher, and that's a conservative estimate. Now that brings us on to a proof in concept on the next slide. As Nick says, around half our portfolio is multi-let industrial estates, and what you see on the slide here, the case study is on Stanley Green Trading Estate, which we acquired in December 2020, and we paid £17.25 million. It's located in Manchester, just south of Manchester. And when we acquired the asset, it had an existing estate and a 3-acre development site next to it. And you can see that in the photo on the top left-hand side. Our strategy with respect to the new development, well, the development site was to build 80,000 square feet of new warehouse accommodation. We made a conscious decision to spend around 20% more on that CapEx in order to ensure this accommodation had the best possible sustainability performance. So, for example, the new units are EPC A+, and then the first A+ units we have in the portfolio. They're BREEAM Excellent, and they're also operationally net zero carbon. And what we've seen is that we've been able to rent these new units for 21% higher rent than the existing units, so the older units that are EPC C or below. And not only are we benefiting from this higher rent, we're also benefiting from a keener yield, so a lower yield that the valuers are attributing to these units. So that means you get more value for every unit of rent that you have. Now, overall, this has been a really good outcome for us and for our shareholders. So the 3-year total return since we acquired it, which was roughly 3 years ago in December 2020, has been 21% per annum. And that has strongly outperformed the benchmark at around 7%. So what this shows is, this is a really powerful example of the new strategy in action. And we look to undertake more of these sorts of developments and refurbishments over time. And that brings us on to the next slide. So we're looking at some of our key ongoing asset management initiatives that we have underway at the moment. The 3 examples are, well, we've done a retail example, an office example, and an industrial example. So if we start with the retail example first on the left-hand side, what we've done is we've partnered with Starbucks, and they're going to build a drive-through in the car park of 2 of our retail parks. And you might have seen these drive-throughs before. They're very popular with consumers. They bring a lot of footfall to the site too. And what we required is that Starbucks have to build these to at least a BREEAM very good standard. And that includes PVs on the roofs and EV charging facilities in the customer base. In terms of the financial impact of this, well, what you can see in the photo is St John's Retail Park, which is where one of the Starbucks pods is going. The average rent at that retail park is around £20 per square foot, whereas Starbucks will be paying us £86 per square foot. So really good income generator for us at St John's. And not only are we getting high rent, but it's a 15-year lease to a strong covenant with inflation-linked rental increases. Now, moving on to the Ton in Edinburgh. This is a multi-let office. It's located in Edinburgh city centre, near to the Scottish Parliament and the Royal Mile. And what we've done here is we've just completed a £2 million refurbishment, where we've looked to really push on the sustainability performance of the asset. So we've improved the natural light by adding roof windows. We've improved the fresh air provision to the units. We've removed staircases to improve the flow and add space. We're also adding end-of-journey facilities, such as changing rooms, cycle storage, showers, etc., to encourage more sustainable modes of transport to the office. Now, before we started this refurbishment, we had 3 vacant units. And since then, we've let 2 already. And the final unit is actually the one you can see in the photo. That is now under offer. And the ERV for this unit, so the rent that the valuer thinks that we should get based on their view of market rents around the area, is £27 per square foot. But we have this under offer at £32 per square foot, which is a 19% increase. So it just shows the power of pushing on the sustainability performance to attract better tenants and higher rents. And once that unit is let, this asset will be 100% let. Then the final example on the slide, we show Stirling Court, which is 3 industrial units on an established industrial estate in Swindon. We've undertaken a really high quality refurbishment there. So these 3 units, they all came back to us. So they were all vacant around 12 months ago. One of them that we let almost immediately. The tenant wanted to undertake their own works, which was fine with us. So we let the unit to them, and they're happily in situ at the moment. And then the other 2 units we've undertaken this high quality refurbishment where we've pushed the EPC on to at least a B. And in terms of the rent, well, the tenants that were there previously were paying £6 per square foot. We're quoting £7.50 per square foot, which is 25% increase in rent. And actually, we've got one of the units with interest at £8 per square foot, so even more than 25% uptick. So again, it shows if you undertake these quality refurbishments in the right places on the right assets, you can get this really strong rental growth. Now, moving on to the next slide. What we show here is an analysis of our 3-year investment performance. So if we look at the chart on the left-hand side first, what we're showing here is just how much we normally invest in the portfolio. So in round numbers, if we think of SREI, so the left-hand side, in the last 3 years, we've invested around £100 million into the portfolio through acquisitions, capex, and developments. Now, the average value of the portfolio in round numbers is around 500 million. So that means we've invested 20% of the portfolio value into the portfolio. Now, that compares to around 16% for the benchmark. So clearly, this shows already we're more active than the benchmark in terms of the active asset management we undertake that Nick's outlined earlier on. But we think as we implement this new strategy, we'll be investing more into the portfolio to create more resilient and liquid assets and to really push rents and values on where the real estate fundamentals support that. So we expect investment in the portfolio to increase. Now, on the right-hand side, we show our total return over the last 3 years at the portfolio level. So for SREI, that's 6.7% per annum over the last 3 years, whereas the benchmark was 2.2%. So already strong outperformance over the last 3 years. And what the blue and red bars signify is blue is income return and red is the capital return. So we outperform the benchmark on both income return and capital return. And Nick outlined earlier our high yielding portfolio and how we have been able to generate that higher income return over time. So what we hope, and our thesis is implementing this really clear approach to sustainability will enable us to enhance our total returns going forwards. And then moving on to the final slide from me, we've shown some information on our debt structure or our balance sheet. And the point we really like to emphasize is just how strong our balance sheet is, and it's a real competitive advantage compared to other peers or other real estate companies. We've got 2 debt facilities, a term loan and an RCF, and you can see those on the left-hand side. And it's really the term loan that underpins the strength of our balance sheet. So we've got £129.6 million drawn from Canada Life, and that is at an average fixed interest cost of 2.5% and an average maturity of more than 12 years. And what that does is it really underpins the strength of our balance sheet, and it gives us really good visibility on earnings looking forwards, on costs and therefore on earnings looking forwards. And this has been a factor in enabling us to increase our dividend over the last 2 years. And actually, we're the only company in our peer group to be paying a dividend higher than the pre-pandemic level. And then just to finish the picture, we have an RCF. The facility size is 75 billion. We've only got 46 million drawn at the moment. And the majority of that 46 million pound is hedged. So 30.5 million pound is subject to an interest rate collar with a cap at 4.25%. And there's a small amount that's floating. So overall, 74% of our drawn debt is fixed at 2.5% for a very long time. 91% of our drawn debt is either fixed or capped. And our net loan to value is 36.6%. So with that, we'll move over to the next slide, pause for any closing comments, and we'll be really happy to take any questions.
Great, thanks, Bradley. So James, I'd say these, I think, are hopefully self-explanatory. I think we think we're in a really interesting place, particularly with this strategic evolution. But just conscious of time, happy to pause there and take any questions.
Sure, thank you very much, both. Actually, that's interesting. If I go back to the portfolio composition slide, she's back here. There we go. Oh, too far. So is this broadly where you want the portfolio to be, or how do you see that's kind of shifting over the next few years?
Yeah, good question. I think we're happy with where we are at the moment, I guess is the first thing to say. And we deliberately increased our industrial weighting with projects like Stanley Green that Bradley's mentioned, and we've got some other projects, where we've been developing infills effectively to create operational net zero space, which we're in the process of leasing up. So, and I also think, we think that having had a period of incredible polarization between the main sectors, over the period from 2018 to the peak in June 22, average industrial values doubled, whereas average retail values halved. I mean, it's really striking. And I think going forward, although actually we think multi-industrial probably will outperform the other sectors, it will be by a lower margin. And actually, the vast majority of return will come from income. So I think that means, we will be continuing to focus on maximizing infra asset management, but also, if we sell, as we are doing, some of our smaller assets, we may choose to go into some of those more high yielding sectors, possibly even offices in those big regional cities, if we feel that we can drive that income return, particularly where we can deliver those sustainability improvements. So I'd say, I think a real benefit for investors today being diversified, but really importantly, where you've got that higher income return. Do
you think that retail property is actually starting to look more attractive now?
I do. I genuinely do. I mean, we've seen the retail component of institutional portfolios contract incredibly. So, there are very few, funds like ours, for example, that will own shopping centres, because the market's become, again, polarised. People have tended to want either experience from retail, and hence, the big sort of shopping centres like Liverpool One, which Land Securities are obviously rumoured to be buying at the moment, or we've seen probably stronger demand at the convenience end of the market, and that's because you've had companies like Lidl, Aldi, Home Bargains with great space requirements. They're growing as retailers. So, we've focused on buying those retail warehouse assets, typically where we can first of all attract those types of occupiers, and very positively, they will quite often take long leases with inflation-linked reviews. But also, as Bradley's articulated, you can do some asset management, like putting Starbucks pods in the car park. So I think having had really sort of 10 years in the doldrums, the outlook for retail, I think, is more positive. But we will remain selective, and as I say, partly because of size, be focused very much on the convenience end. Fair
enough. That makes sense. Are you seeing that there's sort of quite a lot of transaction volume going on in the sector, or are people still holding off?
Great question. Short answer is no. No, insofar we're not seeing much. I think if you look at the data for Q4 last year, it was the lowest quarterly turnover since the GFC. And actually volumes for 23 for the full year were half what they were in 22. And it's principally because obviously investors have been unclear on the inflation outlook, what that then means for the interest rate environment. But we are detecting a change in sentiments. Some of the people listening may, for example, have seen comments made this week by Blackstone, obviously a huge global real estate investor, sending signals that they are beginning to see this as an interesting opportunity across Europe. And we obviously, we've said, we share that view. If we're not at the bottom in capital values, we're close to the bottom. And particularly with companies like this, where investors can also buy the shares at a discount to a very recent NAV. So we think the sector does look really now quite interesting.
Now, looking at the sort of transition, or sort of more emphasis perhaps on sustainability, what kind of amounts of money are we talking to take the whole portfolio up to where you want it to be, and what do you think the kind of return on investment roughly is going to be on that?
Yeah, so good question. I'll pass this to Bradley in a moment. I mean, we're doing a full review of the portfolio at the moment, including a number of net zero audits, which we will be using then to model the interventions that we think we need to implement in order to really drive a green premium. So we're aiming to give shareholders much clearer visibility on that when we announce our year-end results to March, which will be in June. Worth noting also that we are quarterly valued independently, so we will also be announcing our unaudited NAV to December at the end of February. So just so if people want to keep an eye out for that. I mean, we've always tended to be quite active. We've always been investing in our portfolio. In the last couple of years, we've invested, north of probably 15 million into the portfolio. And I think this strategy will mean we do invest more than that. And our strategy is that we will look to sell some of our smaller assets where we're less confident about being able to deliver those improvements, use that cash to repay part of our revolving credit facility, which would be accretive to income, and then obviously redraw on that as we invest in some of our larger assets. So not a huge shift, but I think the portfolio will probably end up looking a bit different with this evolution than it may otherwise have done. Fewer, bigger assets, but importantly focusing on those assets where we can drive higher returns through those sustainability improvements, but importantly, where occupiers are prepared to pay that premium. So Bradley, I don't know, do you want anything you want to add to that?
Yeah, so I don't think the strategy is to just suddenly go out and upgrade all of our assets. It's really about timing and on a case-by-case basis where we see that the CapEx will deliver a strong return in terms of rental growth and valuation. In our circular, which we released in December, we did say that there will be, there's potential for up to £37 million of CapEx to be invested into income and value enhancing initiatives over the next 3 years. And as Nick said, we're always refining that estimate as we go forwards. And in terms of the extent to the sustainability improvements, it really will be driven by the real estate fundamentals. So, for example, in Swindon, we went for a minimum EPC B, Whereas at Stanley Green, where we're looking for a minimum EPC A plus, BREEAM excellent, because the numbers really stacked up well. So it really is case by case.
Have you got a kind of an average EPC rating for the whole portfolio?
We do disclose our EPCs in the annual report. We're 100% MEES compliant, which is important. And otherwise, we have a lot of Cs, and over time, if regulation does come into play by 2030, they need to be Bs. But yeah, the main point is we're currently 100% MEES compliant.
You're going to have to explain to me what MEES is. Somebody's just asked a question about that as well.
It's basically the sort of minimum energy standard that you have to have. So at the moment, it's quite relatively easy, but soon you need to have an EPC C. So that's supposed to come in 2027, and then from 2030 you're supposed to have an EPC B. Otherwise, you're not able to let the space. And there are some exceptions, but that's the general rule.
Yeah, they are. I mean, it's worth noting, Bradley, isn't it? They are a bit of a blunt instrument in that they are an assessment based on a hypothetical occupier rather than actually telling you how the building performs in use. And we provide some feedback into a consultation that the government are running now, which is looking to potentially move to more of a building in use assessment, which we would strongly advocate. Our strategy is about delivering improvements, so we will typically be buying assets that have a lower profile, but then as part of our asset management strategy, we will deliver those improvements. And hence, for the first time, well, not for the first time on our industrials, but you've got an EPC A operational net zero on Stanley Green. We also got an EPC A following the refurbishment project in Edinburgh. So we have an eye on that, but actually we expect regulations will probably evolve to a focus which is much more on how landlord and tenants are going to work together to ensure the building is designed and used as it should be.
We're asked here about the higher rates and whether they're cost effective for the tenants or not, being in upgraded properties. I suppose there are some benefits in terms of heating bills and things.
Absolutely.
And generally, how willing are tenants to pay for higher rents on these places?
I mean, the evidence that we have, as Bradley's outlined, clearly shows that tenants are prepared to pay for it. I mean, as I say, it's partly because bigger occupiers have made their own net zero commitments, and therefore taking more energy efficient space, obviously helps with the way that they're reporting their carbon use. I think, very often, Stanley Green is a good example. The ESG enhancements are part of a bigger package of just providing good quality real estate. So, for example, in Edinburgh, the Ton, yes, the building is more energy efficient and therefore it will cost less for tenants to occupy. But we've also put in improved bike storage. We've improved the natural light. We've improved air quality in the building. So, these things have a whole host of benefits, which ultimately tenants just pay more rent for. Okay,
fair enough. Now, looking at your sort of office portfolio, have you got any exposure to WeWork? And generally, what do you think about flexible office space?
So, no, we don't have any exposure, first of all. We don't have any real direct serviced office exposure where we have third parties on leases, but we do run flexible office leasing ourselves. So the building that I mentioned, for example, in Manchester City Tower, that building is big enough for us, working with our property managers, to offer very flexible leases, and obviously as part of that, including fitted out space. So where we're providing the tenant fit out, and that works very well as part of a strategy for a building that incorporates long leases to government tenants for 10 years, which is partly in that building, but to complement that, where you have got more flexible space, because then you can ideally move people around the building. So I think real estate as an asset class is becoming increasingly operational. Going back 20 years, it wasn't quite lease and leave, but typical tenants were generally prepared to take longer leases. What we're seeing now is, in parts of the market, tenants require higher levels of flexibility, and so it's right that we respond to that. And the problem with models, and I won't talk to a particular company, but this concept of borrowing long and selling short, has in downturns proven difficult. But actually, as a landlord, where you already own the asset, if you've got the expertise as we do to provide that operational excellence, then you can drive high return.
Fair enough. Obviously, if you're refurbishing something, it's got to be vacant. But what's the general vacancy rate in the portfolio, and is that something that you're happy with at the moment?
Yeah, Bradley, do you want to take that?
Yeah, sure. So our current vacancy rate, so as at the end of September, is around 11%. And that's within our 10-year range of 5 to 13%. But it is towards the upper end. And, typically our portfolio is probably around 8% void, maybe slightly less. And that's for the reason you outlined. We do need time to implement the CapEx programs, and particularly with multi-let estates, there can be turnover of tenants, and there'll be some time between them. So the reason for us being at 11% rather than down at 8% is it was only very recently we completed the Stanley Green development. So we suddenly took on 1.3 million of ERV that was void. If you adjust for Stanley Green, then our vacancy rate is actually 8.9%, which is much closer to where we would expect to be. And what we expect to happen is our void will trend down to around 8% over time as Stanley Green gets let up, as the good progress at the Ton, so the office in Edinburgh we spoke about, gets reflected in the void numbers. But a really important point to note is our void, it's not sitting there waiting to be refurbed. It's largely refurbed and ready to go. So that should accelerate the time we get back down to around 8%.
Okay. Are we traveling towards a sort of state where the fund is all about buying property that needs upgrading and making capital gains and yield improvements from that?
So, in a sense, that's what we've always been about. I think the strategy has always been driven first and foremost by income. Real estate is an asset class. That's the one thing it really offers long term. If you look at the long term total return from real estate, the vast majority of that has come from income. And I think particularly in the we've had this sort of secular sort of reduction in interest rates over the course of the last 20 years. That rates aren't going back to where they have been, and therefore buying high yielding assets where you can drive higher income growth, we think is going to be really attractive and will lead to more capital flow into the sector. So I think the strategy, we very deliberately describe it as an evolution, because we have always been active managers, but I think what we're saying is, look, there's an even more focus on the operational excellence, the sustainability dimension, and therefore, you probably will see more capital expenditure being invested. You probably will see more smaller asset sales being deployed into bigger assets. But ultimately, the objective is to do that in order to drive higher income growth. Great.
That's all very interesting. Thank you very much, both. And thank you very much for stepping in, as I say, again, short notice. That's really good.
It's a pleasure. Thank you for your time.
Good to be here. Thank you.
Cool. So we will be back next week. I'll be talking to Next Energy Solar. We'll also have Andrew McHattie on as well. We're hoping to get Richard back on the 16th. We'll just have to confirm that, but I think that's going to happen. We'll be talking to Atrata on the 23rd. I think that's interesting, because we've been talking now about quite a lot about sort of putting solar on commercial buildings and things. That obviously that's what they're doing. But we have got a fairly full lineup. You'll see something new on the 22nd of March there. We are putting together a panel discussion on the 22nd of March. So we're going to do this sort of once a quarter, where we get 3 or 4 managers together and pose a set of questions to them on a sort of theme. So we'll let you know more about that nearer the time. So in the meantime, have a good week, and I will see you next Friday.